What I am about to describe sounds like a headline you'd scroll past and laugh at. But this isn't satire. This is the kind of, are you kidding me? Moment that only appears right before a market breaks. Right now, a market worth hundreds of billions is being slammed, not by a mine closing, not by a refinery disaster, not by war, but by a single political decision involving a frozen island in the North Atlantic. And that tells you how fragile the system really is. It's Sunday, January 18th, 2026. While most people treat this day as entertainment, scrolling headlines, laughing at memes, watching late-night jokes, the bullion world is tense. Inside, there's no laughter. Panic is quietly brewing. Because hidden in the Greenland story is a single sentence that threatens to rip the plumbing out of the Western silver market. A 10% tariff on imports from several European countries, including the UK, starting February 1st. And if Greenland negotiations fail, that tariff jumps to 25% on June 1st. To most, that's politics. To risk managers at bullion banks, it's a warning label on a live grenade. The fact that a market this size could be destabilized by such a policy tells you the system was already tight. And when it's already tight, even a small shock can behave like a massive one. To understand why this matters, you need to see the mechanics. The global silver market runs on a simple assumption. An ounce is an ounce wherever it sits. London bars are treated as interchangeable with New York bars. This fungibility is only possible because the big players can move metal between hubs at will. That flow is oxygen. Remove it, and the system starts choking. The two biggest hubs are London and New York. London, via the LBMA, is the heart of the physical wholesale trade. New York, via COMEX, is the center of futures pricing and paper leverage. For decades, banks have juggled between the two. When New York heats up, bars fly in from London. When London looks thin, New York ships over. The public sees stability. Insiders know it's a high-wire act. Now imagine a wall in the middle of that act. That's what this tariff does. It's not emotion, it's math. Anything shipped from the UK into the US now carries a 10% cost. London is in the UK. The LBMA ecosystem is now inside a tariff zone. Here's the nightmare scenario for bankers. You ship metal from the US to London to relieve pressure there. Great, for now. But when that metal needs to return to New York for domestic deliveries, the tariff hits again. At $90 silver, a 10% tariff is $9 per ounce. That's not a minor fee. It destroys arbitrage, kills swap economics, and eliminates the flexibility the system depends on. If the tariff later rises to 25%, it becomes an embargo in all but name. Before markets open on Sunday, risk teams are already making calls. Stop moving metal. Exporting silver into a tariff zone is gambling that it will never be needed back. That's not a gamble any institution takes when inventories are tight, and inventories are tight. London has been bleeding metal, shuffling paper and promises to maintain the illusion of normalcy. London is the weak link, and here's why this could become historic. For years, the LBMA vault system has been losing physical silver eastward. India and China have been absorbing metal strategically, not speculatively. That drain has left London inventories low, and what remains is often tied up in ETFs, leased positions, unallocated balances, metal that can't be delivered freely. The truly free, deliverable silver is scarce. Add the tariff wall. If New York can't safely ship metal to London and retrieve it later, London loses its emergency supply line. It becomes a besieged city. When a hub is besieged, prices stop being global, they go local. That's the start of a split market. Once traders realize metal can't move freely, you'll have different prices in New York and London. The law of one price dies, not because physics changed, but because policy did. Borders always mattered, but for 30 years, the costs were low enough that traders could pretend they didn't. Now borders matter again. The moment arbitrage is blocked, the spread can't be instantly closed. That terrifies banks, whose hedging models assume spreads remain tight. If London jumps to a premium, previously hedged positions turn into losses. Here's where mechanics matter. Location swaps. A bank can swap ownership claims between New York and London instead of physically moving metal, maintaining balance. But swaps rely on the assumption that metal can be moved later. A tariff turns flexibility into a trap. Metal can check in, but it can't check out. It gets hoarded. The US becomes a one-way valve. If you are a domestic industrial consumer, that can be bullish for supply security. But if you are London, trying to survive on imported liquidity, that can be lethal. Here's where most people miss the plot. They think, if silver is trapped in the US, won't that increase supply here and push price down? That sounds logical, until you remember the market isn't just physical. It's a complex web of paper promises, hedges, and confidence. When confidence breaks, price doesn't follow supply. Price follows panic. If London begins to show strain, the immediate reaction in New York won't necessarily be a crash. It can be a bid. Banks and funds rush to rebalance exposures. Shorts that felt comfortable become terrifying. Everyone wants to be less short, more long, more protected. In other words, the moment London looks like it might crack, the reflex is to buy protection in New York. And that buying pressure can lift prices, not lower them. So the tariff doesn't just change flow, it changes psychology, it changes risk. And risk is what moves markets. Is this really enough to shake the silver market? That depends on how tight physical supplies are and how aggressively the paper system leaned on easy logistics to keep the game going, which is why timing matters. If London were overflowing with deliverable silver, banks could shrug and absorb the cost. But this is not that year. People are watching vault data, seeing drawdowns, noticing demand spikes, and asking uncomfortable questions. Now the system faces a tariff wedge that breaks the circuit between the two major hubs. This is what black swans look like. Not an asteroid, not aliens, but a mundane policy change nobody modeled for, arriving at the worst possible moment. Algorithms are not built for this. Trading bots react to macro variables, interest rates, the dollar, industrial indicators, maybe a few sentiment feeds. They do not account for the consequences of a geopolitical real estate dispute on bullion logistics. That's why human judgment still matters. The machine sees tariffs, the machine sees trade disputes, the machine sees noise, the human sees pipeline rupture. Let me make this painfully concrete. A wholesale silver bar is not digital data. You can't stream it. Moving it requires transport, insurance, chain of custody, customs paperwork, assay verification, and vaulting at the destination. The system depended on the idea that once you paid those costs, no surprise extra taxes would turn the trip into a loss. Tariffs do exactly that. They add variables outside the trader's model. Traders hate variables they can't hedge. Think about what a tariff really is. It's not just a fee, it's a statement. This border matters again. When borders matter, the world stops being one market and becomes a collection of smaller markets, each with friction. That friction breaks paper pricing. Here's an example. A bank sees silver at $90 in New York and $98 in London. In a frictionless world, that's arbitrage opportunity. Buy in New York, sell in London, close the spread. But now, with tariffs, shipping, insurance, financing, vault fees, and the risk of future penalties, that $8 spread might vanish, or worse, become negative. The bank does nothing. The spread persists. The public wonders why silver suddenly behaves like a closed market. It is a closed market. And there's another angle, trust in the settlement chain. A large buyer in Europe hearing U.S. supply lines are uncertain, doesn't wait to find out. They pull forward purchases, demand allocated metal. That behavior itself creates shortages. Here's the striking part. The tariff isn't even live yet. February 1st is the date, but markets move on expectation. Vault operators reroute shipments. Banks adjust. Industrial buyers lock in supply. Effects start before the policy officially starts. Now consider premiums. You see spot at one price, but pay more to buy. That's not greed. It's the market pricing in risks ignored by the screen. Tariffs, logistics, and uncertainty. Premiums widen first, revealing hidden stress. Rising premiums indicate real scarcity before the price on the screen reflects it. Here's a mental model. Think of silver as 3 layers. Layer 1, paper price on screens. Layer 2, wholesale physical between hubs. Layer 3, retail physical in your hand. In calm times, layers track each other. In stress, they decouple. The truth is, in layer 3, the tariff hits layer 2, disrupting wholesale flow. That disruption bleeds into layer 3. Layer 1 pretends nothing happened until it can't. This is only the first chapter. If tariffs trap metal, countries will compete to trap more. The era of global pricing may end. Regional premiums could become permanent. Nominal prices must adjust to reflect shortages, incentivize supply, and account for geopolitical risk, what's called a repricing event. The institutions that benefited from the old system will resist. They will fight with narratives, volatility, and fear. Monday morning is when this becomes real. London wakes up and realizes it can't rely on New York as before. London is already tight. Scrambles begin. Unallocated accounts convert to allocated metal. Delivery systems are stressed. Delays erode confidence. Cash settlement exposes paper realities. Premiums spike. Banks short on metal face violent losses. Liquidity becomes solvency, and it happens fast, when everyone realizes the exit door is smaller than the crowd. Trapped inventory in the U.S. becomes strategic. Domestic manufacturers care more about securing inputs than Western paper prices. Hoarding begins. Banks, industry, investors, all hoard. Hoarding is how shortages become visible. This tariff wasn't key, intended to destabilize silver. But consequences are dangerous precisely because no one planned for them. Exporting and re-importing becomes financially toxic. Structural changes like this don't reverse overnight. If London can't source enough physical metal, the global pricing system loses legitimacy. Paper prices stop being the reference. Physical delivery sets the real price. And if the West can't deliver, the East becomes the anchor. Shanghai sets the tone. Eastern pricing is tightly tied to physical reality. tolerates less leverage, and lacks appetite for infinite paper. A shift in price-setting power can trigger a repricing event, not a gradual drift. Finally, spreads will start screaming. Normally, banks arbitrage New York versus London, keeping prices aligned. Tariffs prevent that. Segmentation appears, screens mislead, paper holders face risk, physical holders see opportunity. This is the reality. The layers are separating. Paper pretends all is normal. Wholesale is stressed. Retail holds the truth. And that truth is what will guide the next moves in the market. If you go to buy physical silver and notice premiums jumping, that's the tariff effect and the logistics effect bleeding into retail. Longer delivery times, that's stress. Out of stock banners, stress. And if mainstream media is still laughing about Greenland while those signals appear, that's your tell. That's your opportunity. The crowd laughs right before the stampede. Here's the part the banks hate most. Once logistical friction enters the system, suppressing price becomes harder. Suppression, if it exists, requires flexibility, the ability to source metal when delivery pressure builds, to shuffle metal between hubs, to cool panic. It requires confidence in the plumbing. Tariffs clog the plumbing. When plumbing clogs, pressure builds. That's why a simple tariff matters. It doesn't just add cost, it adds friction. And friction in a leveraged system is explosive. Now let's add another layer. Industrial demand. Silver isn't just something people stack in safes. It's an industrial input for electronics, solar, defense, medicine, and more. If domestic supply becomes strategically important, policy can shift. Buyers step in earlier. Governments and corporations hoard. A tariff can inadvertently act like a national stockpile policy with all the unintended consequences that entails. The unintended consequences that entails? Timing matters too. February 1st is the 10% tariff start date. June 1st is the threatened escalation to 25% if Greenland negotiations fail. Even if dates shift, the market now has a timeline. Traders hate timelines. They create cliffs. Cliffs create front-running. Nobody wants to be the last buyer before a wall goes up. Shipping decisions change immediately. Hedge decisions change immediately. And when flows change, price follows. Banks will try to confuse the public. They'll call it temporary, say it's already priced in, distract with statistics, highlight warehouse numbers or paper claims. But in tight markets, the marginal bar matters, not headline inventories. The marginal bar is the one that can move between hubs exactly when it's needed. Tariffs attack that bar. Think about London. The fuse is lit there. If London can't access US metal, it must source elsewhere. Europe is on the tariff list. Asia is absorbing supply. Mines aren't flexible. Refining and shipping take time. London can't solve this quickly. So what does London do in a crisis? It delays, offers cash settlements, encourages rollovers, tweaks rules and contracts. Every adjustment chips away at confidence. Now consider a scenario that could make history. London starts settling in cash because it can T-source metal fast enough. It's framed as normal, liquidity management. But the market hears a different story. They didn't have the metal. Once that thought spreads, it doesn't leave. Every investor holding unallocated metal asks, if they didn't have it for that guy, do they have it for me? That's the beginning of a run. Runs are never polite. In New York? Safer, maybe, but not immune. COMEX is heavily paper leveraged. Contracts are multiples of the deliverable float. It works because most people don't demand delivery, and banks manage flow to maintain the illusion of infinite supply. But if London pressure sparks a global scramble, delivery demand hits New York too. London is the first domino. New York is next. You don't need a perfect prediction for Monday to understand the pressure. What changed? The ability to move metal without punishment. When that ability breaks, the market stops being one pool and becomes a series of puddles. Some puddles dry out, some overflow, prices diverge. That's how hidden stress becomes visible. The world of silver on Sunday morning is fundamentally different from Friday. The Roach Motel logistics are exposed. London faces a crisis. The era of a frictionless, unified global silver market is ending. Tariffs reintroduce the laws of physics and geography into a market that had forgotten them. The future is about structure, not headlines. We're entering regional pricing. Metal inside the US trades like strategic silver. Metal in London becomes stranded, disconnected from swing supply. Banks can no longer suppress price smoothly. Tariffs create basis risk, the nightmare of every commercial institution. Hedges fall apart. Shorts become dangerous. Paper pressure weakens. Without artificial pressure, silver is free to find equilibrium, a brutal equilibrium that reflects energy, labor, capital, and industrial value. For the individual, in a world of trade friction, the safest place for your metal is where you are. Borders are taxes. Movement is risk. Stop worshiping spot. Screen prices can be misleading when markets split. Value your stack by replacement cost. Can you buy it back? At what premium? With what delivery time? Accept volatility as a weapon. Moves designed to scare weak hands are part of regime changes. Volatility removes them before the next leg higher. Key takeaways. The UK tariff creates a cost barrier, discouraging silver flow between New York and London. Discouraging flow breaks the arbitrage that unifies global pricing. London is already physically tight. Cutting its emergency supply accelerates default risk. Segmentation can create persistent regional premiums. When confidence breaks, paper holders rush toward physical, pressuring both hubs. Signals are spreads, delivery times, premiums, and rule changes. Not jokes about Greenland. Cliffhanger. If the West's price depends on free moving metal and policy now makes movement expensive, what happens to the value of paper, promises that assumed free movement forever?